Right now, there is more money in bank accounts around the world than physically exists. Not slightly more, enormously more. And almost nobody asks the obvious question. What happens if everyone tries to get it back at the same time? Most people believe money works like a storage system. You earn it, you deposit it, the bank holds it. When you want it back, you take it out. That picture is clean, logical, it feels true, and it is almost completely wrong. The money you deposited today is not sitting in a vault with your name on it. It was lent out within hours, to a stranger, to a company, to someone buying a house they have never seen. Your money became their loan, and their loan became someone else's deposit, and that deposit became another loan. The same $100 multiplied, moving, working, everywhere and nowhere at once. This is not fraud. This is not a conspiracy. This is exactly how the system is designed to work. But there is one detail nobody explains at school. One detail that sits quietly underneath every bank, every economy, every currency in the world. And once you see it, you cannot look at your savings account the same way again. We will get to that detail. But first, let's go back to where money actually begins. Here is what most people think. The government prints money. The central bank, the Federal Reserve, the European Central Bank, the Bank of England controls how much exists. And from there, the money flows down to regular banks, which distribute it to people. That is the official story. And part of it is true. Central banks do control something. But here is the part nobody tells you. The majority of money in circulation today was not printed by any government. It was created by ordinary commercial banks. The ones on the high street. The ones with your mortgage. The ones processing your paycheck. They did not find the money somewhere. They created it. Not out of thin air, that is too dramatic. Out of a promise. Out of a number on a screen. Here is how it works, and it is simpler than you think. Imagine it's 2005. You walk into a bank and ask for a $10,000 loan to renovate your kitchen. The bank checks your income, your credit history, decides you are reliable. Then something happens that most people have never thought about. The bank does not go to a vault, count out $10,000, and hand it to you. There is no pile of cash somewhere that gets smaller. The bank simply types $10,000 into your account. That's it. One moment the money did not exist. The next moment it does as a number on a screen, and now you can spend it, transfer it, pay a contractor with it. That money moves. Someone gets paid with it. They deposit it somewhere else. Another bank lends part of it again. Same money, new loan. The $10,000 the bank created keeps multiplying. Each stop along the way, it gets lent out again. This is called fractional reserve banking. The word fractional means that banks only keep a fraction of deposits on hand. The rest they lend out repeatedly. Think of it this way. If you kept a wallet for 10 friends and they each gave you $100 to hold, you would have $1,000 in the wallet. You know all 10 friends. You know they rarely all ask for their money back at the same time. So one day, you quietly lend $800 to someone else, keep $200 in the wallet, and collect interest on the loan. As long as your friends do not all show up at once, the system works perfectly. You look trustworthy. Everyone is happy. That is a bank. Every bank. Now, here is the part that should make you pause. The bank did not lend you existing money. It created new money by lending it into existence. And that money moves around, people spend it, businesses receive it, other banks hold it as if it were completely real, because it is real, as long as nobody panics. Here is the strange part. That $100 you deposited, the bank keeps maybe $10 and lends out $90. That $90 lands in another bank. that bank keeps $9, lends out $81, and so on. By the end of this chain, $100 has turned into almost $1,000 of loans moving around. In some countries today, banks are not even required to keep that 10%. They keep less. The chain goes further. This sounds impossible. It is not. It has been working this way for over 300 years, since the first modern banks appeared in Amsterdam and London in the 1600s. The system runs on one ingredient: trust, which is exactly why it fails the moment trust disappears. Imagine it's 2007. Northern Rock is one of the largest mortgage banks in the United Kingdom. Hundreds of thousands of British families have accounts there. Their money, by all appearances, is safe. Then the news breaks quietly at first. Northern Rock has run out of cash. Not because it stole anything, not because anyone broke the law, but because it had lent out far more than it held. When the market that allowed it to keep borrowing to fund those loans froze up, Northern Rock had nothing left to give people back. By the morning of September 14th, the lines outside Northern Rock branches stretched around the block, people waiting since before dawn. Not panicking, just quietly, determinedly, choosing to get their money before someone else did. A restaurant owner in London stood in one of those lines at 6 in the morning. Payroll was due on Monday. He was not trying to get rich. He was not making a move. He just needed access to his own money. And he was not sure he would get it. By the end of that day, £4 billion had been withdrawn. A bank run, the most dangerous thing in modern finance. It does not matter if, on paper, a bank has enough to cover everything it owes. In a bank run, on paper, means nothing because the money is not there. It is in mortgages. It is in loans. It is sitting in deals made years ago. It cannot come back fast enough. The system works fine until everybody gets scared at the same time. This was not the first time, not even close. In 1930, the United States had just entered the Great Depression. Banks across the country had lent aggressively through the 1920s, fueling a decade of growth. When the economy turned, confidence cracked. One bank in Tennessee collapsed, then another. The news spread. People across the country walked to their banks, quietly, determined. By the end of 1930, over 1,300 American banks had failed. Not because they were criminal, not because they were poorly managed, because the fractional system, under enough simultaneous pressure, cannot hold. The money that people came to collect simply did not exist in the form they expected. 9,000 American banks failed before 1933. The savings of millions of families gone. Not stolen, just mathematically unavailable. There is one detail almost no one knows about this period, and it changes the way you understand what happened next. In 1933, President Roosevelt did something no American president had done before. He ordered every bank in the country to close for 4 days. A bank holiday, they called it. The government needed to stop the runs. It needed time. When the banks reopened, some of them never did. But the panic, at least temporarily, had a lid on it. The government did not save people's money. It saved time. The money, in many cases, was already gone. But none of this explains the strangest part. If governments know the system is this fragile, why are they comfortable keeping it exactly this way? We will get to that. But first, picture this. Now put yourself in this position. It is 2023. You have $40,000 saved. It took you 7 years. You have it in an account because that is what responsible people do. You do not think about whether it is really there, because why would you? You saw the number. You logged in this morning, $40,247.31. But that number is a claim, a promise, not cash in a box. The bank that holds your account is simultaneously holding thousands of other promises to other people, to businesses, to investors. As long as those promises do not all come due at the same time, everything functions perfectly. What would it take for them to come due? A rumor, a social media post, a financial journalist using the wrong adjective. In 2023, Silicon Valley Bank, a respected American institution with $200 billion in assets, collapsed in 48 hours, not because it was fraudulent, because a message spread through a network of tech startup founders that the bank might be in trouble. Within 2 days, $42 billion had been requested for withdrawal. The bank had nowhere near that amount available. It was seized by regulators by Friday morning. $42 billion in 48 hours because of a message on a phone. And here is the pattern, and here is the answer to that question. Why are governments comfortable with a system this fragile? Because it works. Because it has always, eventually, been propped up. Because when it breaks, governments step in with guarantees, with emergency laws, with closed banks and frozen transfers. They manage the panic, they buy time, and then the system restarts. The fragility is not a bug they are trying to fix. It is a feature they have learned to manage. It happened in Amsterdam in the 1690s, the first recorded bank run in modern history. It happened in London in 1866, when a powerful bank called Overend, Gurney and Company collapsed in a single day, and panic spread through the city within hours. It happened in Argentina in 2001, in Iceland in 2008, in Greece in 2015. Every time, ordinary people discovered too late that the number in their account was a record of a promise, not a record of something sitting somewhere, waiting. The countries change, the decades change, the outcome does not. Here is what this reveals about how money actually works. Money is not a thing, it is an agreement. And agreements fail surprisingly fast when people get scared. When you deposit $1,000, the bank does not lock it in a box for you. It writes down that it owes you $1,000. Then it uses that money somewhere else. Your deposit becomes someone else's loan. That loan becomes another deposit. That deposit becomes another loan. Each promise works. Each one is real. Until someone in the chain stops trusting the next person. This is not a flaw that governments are hiding. Most central banks publish this information openly. The Bank of England published a paper in 2014 explicitly explaining that commercial banks create money when they make loans, not the central bank, not the government. The paper was called Money Creation in the Modern Economy. The paper is public. Anyone can read it. The system works. It has worked for centuries. It built factories, financed wars, helped ordinary families buy homes they could never have afforded with cash. It raised billions of people out of poverty. But it works because we do not all look too closely at the same time. It works because we are patient and trusting, and we do not all ask at once. The moment we all want the same thing simultaneously, the whole thing cracks open. Most people with savings accounts have never asked a simple question, not because they are naive, because the question is uncomfortable. If everyone with a bank account in your country went to withdraw their cash tomorrow, would it be there? The answer is no. It cannot be there by design. Not some of the money, not most of it, Almost all of the money that exists in your country exists only as numbers on screens. Physical cash, actual bills and coins, covers a tiny slice of what people have in their accounts. In many countries, less than 5%. The rest exists because of trust, not law, not physics, trust. There have been 147 documented banking crises in 114 countries since 1970. In most of them, ordinary people with ordinary savings accounts discovered this the hard way, not through fraud, through mathematics. Right now, somewhere, there is a family transferring their last savings into a new account because the interest rate is slightly better. They are being responsible, careful, planning ahead. The same families existed in Reykjavik in 2008, when Iceland's 3 largest banks collapsed within days of each other and the government froze international transfers. They existed in Nicosia in 2013, when Cyprus announced on a Saturday morning that accounts above 100,000 euros would lose a percentage of their balance permanently to save the banking system. They existed in Buenos Aires in 2001, when ordinary people watched their life savings converted from dollars to pesos at a rate that cut their value in half overnight. None of those families did anything wrong. None of them made reckless decisions. They trusted the number on the screen. The number was real, as long as the system around it held. Here is the principle, and it is not comfortable. The money in your bank account is not yours. When you deposit money, you are not storing it. You are lending it to the bank. You are giving them your money, and they are promising to pay it back when you ask. That is the legal reality. And like anyone who owes you money, they are hoping you do not ask for it all at once. This is not a secret. It is in every banking contract ever signed. You gave them your money. They promised to give it back, and then they lent it to someone else. The wallet is still there, the money left years ago. And here is the question nobody asks out loud. If the bank needs your trust to survive what happens the day that trust disappears faster than the bank can react? And the terrifying part is this: every single person who stood in those lines, in London, in New York, in Reykjavik, thought the system would hold one more day. What do you actually hold?